Well, good afternoon, everyone. My name is Nat Winnicky. I'm with the Property Casualty Insurers, run our federal government relations. Thank you all for coming today. It's great to see so many familiar faces in the room. I just want to start off by making sure everyone understood our ground rules for today. This is an open press event. With that said, knowing the panelists as well as I do, I'm sure the dialogue will be very candid and robust today. I do strongly encourage questions for the panelists. Our moderator of our session will make sure there's ample time for you to jump in and ask some questions. There's a microphone right in the middle of the room for your use. You'll notice some cameras in the room today. The event is being webcast to PCI membership. And let us know if you have any interest in the video after the fact, and we'd be happy to talk to you about that. So with no further ado, I'd like to make one introduction. I'd like to introduce Robert Gordon. Robert is the Senior Vice President for Policy Development and Research for the Property Casualty Insurers. Robert spent 18 years on Capitol Hill, albeit for all of our friends on the Senate side, he is a House side guy, so don't hold that against him. He currently is behind all of the thought leadership that PCI puts out and works with our members on, helps develop consensus among the industry. Robert will be our moderator for today's discussion, and without further ado, Robert Gordon.
Thank you, Nat. And we have an incredibly deep bench of insurance expertise here for you today. And as Nat said, I was the insurance counsel for many, many, many years on the House side. These are the people when I had questions or when I need help understanding something and need thought leadership, these are the people that I turn to. I'm going to go ahead and introduce them. Terri Vaughan on my left is a former state insurance commissioner, former NAIC president, former NAIC CEO, dean of Drake University College of Business and Public Administration, named by a major insurance magazines as one of the most influential people in insurance. And when we joke Terri wrote the textbook on insurance, it's actually literal in her case. She did write the textbook on insurance that is used widely. Next to Terri, Tom Leonardi is the senior advisor of Evercore Partners, the former Connecticut insurance commissioner, former executive committee member of the International Association of Insurance Supervisors, the IIS. That's the group that my iPad and iPhone keeps auto-correcting to ISIS for some reason, so we can blame some of those things on Tom that he'll talk about. Tom's also a 40-year veteran in the financial services industry and very much a thought leader and spokesman on many of these issues. To my immediate right is Mark Calabria, the Director of Financial Regulation Study at the Cato Institute. Mark was the former Deputy Assistant Secretary for Regulatory Affairs and at HUD and former staff of the Senate Banking Committee, so unlike my poor House self, Mark was on this side of the world, and Mark also underscores that you can continue to have an exciting future even after leaving the Hill. And then next to Mark is Ethan Sonnichsen, the Government Relations Director for the NAIC, the insurance regulators, and Ethan leads the federal and international efforts for the state insurance regulators. He's subbing for Christina Urias, who had a family emergency. Ethan's a great guy, great sense of humor despite having been at the actuaries before it, so Ethan's been a good leader as well. So we're going to hear their top-of-mind thoughts, each in turn, and then I'll ask a few questions. I'll then encourage audience questions at that point, and we're going to start with Terri on her thoughts on the ongoing international negotiations and how well insurance consumers are being represented. Thank you, Terri.
Thank you very much, Robert. So I know that I suspect most of you here in the room or everyone is familiar with the International Association of Insurance Supervisors, the association of the world's insurance supervisors, created in 1994, and it's evolved over the years to become a very important part of the global architecture related to insurance. It's a place where supervisors come together, they develop common standards, they talk about problems, they essentially jointly problem solve. And one important output of this are the insurance core principles, which the IMF then assesses member countries against to see if they comply. Well, for many years before the financial crisis, there was an intense debate going on at the IIS about the issue of global capital standards. And essentially what was happening, and I came into the NAIC as CEO in 2009, kind of right into the middle of this very intense debate. And essentially what was happening was that some members of the IIS, particularly the Europeans, were encouraging the IIS to adopt a global capital standard that looked much like Solvency II, the European capital standard that they were working on at the time and just became effective this year. And so it wasn't exactly a Solvency II, but it contained key components that the U.S. insurance regulators were skeptical about, things like market consistent valuation, enhanced, very strong role for the group supervisor over legal entity supervision, heavy reliance on internal models. And the NAIC was resisting this movement, in part because it had some fundamental differences of opinion, fundamental disagreements about Solvency II, but also because it wanted to understand better what we were trying to do. So the comment the NAIC kept making, and I was one who made it, Tom was one who made it, we kept saying, let's step back and let's understand what the problem is before we come up with a solution. It's worth understanding, I think, the history of the banking, the global capital standard in banking, which was in fact clearly driven by regulatory arbitrage. It was driven by a need for a desire for a level playing field. It was driven by the fact that the U.S. banks were basically getting their lunch eaten by the Japanese banks. And so the U.S. banks and the U.S. regulators said, we need to do something about this, and they came up with a global capital standard for banking. Well, the Basel Committee then developed this, and I think it became effective in the late 1980s. But I think it's worth noting, and so what we kept hearing at the IIS was we need a global capital standard because of regulatory arbitrage and level playing field. And what we would say, the NAIC, is, okay, let's understand what are the regulatory arbitrage and level playing field issues that we have. It's clear in banking. What do we have here in insurance? Banking tends to have more cross-border issues than insurance. Trading can be done anywhere. When international banks lend to international companies, they have a lot of freedom in how they do it. There's some flexibility in insurance, and certainly we have aspects of global markets. I mean, reinsurance is arguably a global market. But there are differences, and our markets tend to be more local. Our groups tend to operate more through local subsidiaries than branches, which the banks tend to use more branches. And our question was, how do these differences play out, and what does that mean? What lessons can we learn for the design of a global regulatory architecture for insurance, given the market structures that exist in insurance? Now, I've always, I've had a lot of education over my life, and you get told over and over and over again, there's a process for solving problems. First thing is, understand the problem. Second thing is, identify possible solutions. Third thing is, understand, assess the pros and cons of those different solutions, and then pick the one that makes the most sense. For a variety of reasons, that never happened at the IIS. To my enormous frustration, there was a tendency to shortcut that work, to see the problem as simply, we need a global capital standard. Why? Well, because we don't have one. And as hard as we would try, we couldn't get anything more than that. Now, the NAIC's ability to get a deeper understanding of the problems and to drive the IIS to a deeper understanding of the problems was essentially brought to a halt in 2013 when the Financial Stability Board stepped in. And the Financial Stability Board ordered the IIS to develop a global capital standard. Financial Stability Board, I'm sure many of you know, was created in 2009 to promote global financial stability. It's a very worthwhile cause. They deal with with systemically important institutions, banks and insurance companies. They have been trying to deal with the issues of shadow banking. I mean, they do some good work. But unfortunately, they've decided to take a very active role in the insurance space, and there are two problems with that. The first is that there are significant differences between the U.S. insurance regulators and the European insurance regulators, differences of opinion in what the structure of regulation should look like. And it goes to very fundamental questions like, what's the valuation system? It's an important question with important implications. Now, roughly 1/3 of the jurisdictions that are members of the Financial Stability Board are Europeans. and they've been working hard on Solvency II, and they've got a vision on how it's supposed to work. Second problem is that the level of expertise around the table is quite minimal. The level of insurance expertise around the table. There's a lot of expertise. There's not a lot of insurance expertise. The members of the FSB are largely central banks. They are finance ministries. There are some regulators in the mix, and certainly many of the central banks now have regulatory roles, as does our Federal Reserve. But there's no membership other than kind of the International Association of Insurance Supervisors gets an automatic, the Secretariat gets a seat and the chair gets a seat. But for a supervisor who's in there, who's dealing with complex issues, who's working with internationally active insurance companies and the challenges, there's no one sitting on the board. And particularly importantly, there's no U.S. insurance representation at the IAS. So they're well-intentioned, but they have a frame through which they look through things. And I don't even think they're, I'm being very critical, and I had mixed feelings about this because I know they're well-intentioned, but they don't understand insurance. The failure to deal with the fundamental questions from the beginning is now showing up, I think, in a real difficulty in developing the standard. So what you see are these, what do they call them? Quantitative impact studies. Well, we're going to test this and we're going to test this, but it's not clear what is the criteria for deciding whether one approach or the other is better, because the only goal we have right now is comparability and consistency. What valuation system should we use? Most recently, I had to laugh. I was reading some stuff to kind of catch up on this, and I read that the IIS is going to do a consultation in November on how the new insurance capital standard will be used by supervisors. So here we've got, we're developing a standard without a clear idea of what the problem is, or even how it's going to be used. And I find that just remarkable. Now, I have to say, I think there are some positive signs right now, because the Federal Reserve has given a great deal of thought to this, and I was very impressed with what they came out with. I thought it was nearly a pitch-perfect proposal. They rejected a complex, expensive system for the thrift holding companies, and they are looking at something that is particularly targeted at the systemically important insurers, at the insurers that were designated by FSOC. They recognize that market-consistent valuation approach is creating excessive volatility, and it's being pro-cyclical. That's something that the NAIC had warned about for many years. So I think there are good signs, and I'm hopeful that this can cause the IIS to have kind of another level set and make sure they understand exactly what they're doing.
Thank you very much, Terri. Tom?
Thank you. Thanks for the invitation to be here. It's always fun to, I'm very passionate about these issues, even though I'm no longer an insurance commissioner, and it's a tough act following Terri, but I'll do my best. For those of you who don't live and breathe insurance policy and regulation like some of us do up here, you may be saying to yourself, okay, there's the FSB and then the IAS and ComFrame and GSIFI designations and global capital standards and Solvency II. There are other discussions of reinsurance collateral and covered agreements, which we haven't talked about. You may be asking yourself right now, why should we care about any of these esoteric things? And the answer to the question is really quite simple. It's because they're really important issues. They're important to insurance companies and their employees. They're important to consumers and, most importantly, to the U.S. economy as a whole. The attempt to force inappropriate policy measures on the U.S. insurance market against the will of state regulators and those that they regulate would have, in my view, potentially catastrophic implications. These measures will affect the cost of capital, the availability and price of insurance products, and perhaps most importantly, jobs for our citizens. Like Terri, when I was a member of the IAS Executive Committee, I repeatedly urged our international colleagues to be more thoughtful and deliberate in their thinking. Their rush to implement new capital standards on all internationally active insurance groups in the absence of a global accounting standard was and is a solution in search of a problem. The race to label certain companies as systemically risky, even though the business of insurance does not present systemic risk, revealed, again, a bank-centric outlook totally unsuited to the business model of insurance. and the attempt to use a prescriptive, one-size-fits-all approach to the regulation of this industry, along with the European Union's ongoing efforts to cram down Solvency II, their new and as yet untested solvency regime on the rest of the world, all potentially create fatal threats to the insurance consumer in the U.S. It's worth noting that while state regulators have long rejected Solvency II for the U.S. market due to its structure and its potential volatility, Federal Reserve Board Governor Daniel Tarullo recently came out and said the exact same thing. So we should not accept international standards that mirror an approach that both state and federal regulators agree does not work for our market. What makes matters worse, though, is throughout the past several years, the director of the Federal Insurance Office has often supported these international efforts in direct opposition to the will of state regulators. Why does this matter? Unlike other countries, in the United States, it is the state regulators, not a single national regulator, that's responsible for the prudential regulation of this industry. It's important to remember that Congress passed McCarran-Ferguson in 1945, which gave the states responsibility to do prudential regulation of insurance. And when the Dodd-Frank Act was passed, Congress again reaffirmed this policy of providing regulatory deference to the states. And yes, the Dodd-Frank Act gave the Fed the role as a group-wide supervisor over insurers that are bank holding companies and those that were designated as systemic by the FSOC. But these are 6 large companies primarily, and they represent only about 12% of the insurance market in this country. And keep in mind there are more than 6,600 insurance companies in the U.S., and that state regulators are responsible for regulating 100% of that market, including the solvency and market conduct regulation of those companies group-wide regulated by the Fed. Yes, the Dodd-Frank Act created the Federal Insurance Office, but FIO's relevance was limited to macroeconomic and political issues, not the fundamental day-to-day work of insurance regulation. FIO's job should not be to challenge Congress's wisdom and second-guess the states. It should not be to support Eurocentric policies and force those upon state regulators in the face of significant opposition to those policies. In its most recent peer review of the U.S. system, the Financial Stability Board noted that the state regulators do a great job in protecting consumers and ensuring the solvency of the industry so that a promise made is a promise kept. Those two things, in my view, describe the very essence of what it means to be a competent and qualified regulator. Yet the Financial Stability Board, of which the Treasury, the Fed, and the SEC are members, went on to add that we should do away with the state regulatory system and adopt a single federal regulator. The FIO, the FSB, and the European Union regulators may not like our system, but it is one that has worked for over 150 years through the banking panic of the late 19th century and the one in 1907, through the Great Depression, 2 world wars, 9/11, and the Great Recession. Yet we're supposed to think it's a great idea that we throw away this system in favor of the uniform and cost-effective system that is used for bank and securities regulation, that, by the way, failed miserably during the financial crisis. What good is uniformity if it is uniformly bad for consumers? And what good is the cost-effectiveness if we have an inexpensive regulatory system that fails to protect policyholders, particularly when the cost of failure, as we learned so much and so clearly in the recent financial crisis, is so high? Why would any sane person want to suggest this? Thank you.
Thank you very much, Tom. Ethan?
Thanks very much, Robert. It's very gratifying to sit here and just know that, with my former boss and former member, that they really took to heart everything I taught them over the years about insurance regulations. Very rewarding for me personally. So thank you for the opportunity to be here. As Robert said, I'm standing in for Christina Urias, who's the former Arizona Insurance Commissioner. She had a family emergency, but she's one of our leaders on the international realm right now, so I'm occupying, hopefully, her big shoes. Want to touch on a couple of brief things, and then I'm really kind of excited because I know Robert could keep us here all afternoon with questions, and I don't want to deny him that ability, but just a couple of points to pick up on what Tom and Terri have said. I just got back from an NEIC national meeting. We do 3 of those a year. It's where insurance regulators come together and work on regulatory policy. And they do it out in the open. Or I should say they do it in windowless ballrooms in large hotels. But we had about 2,000 people there. Think about that. 2,000 people who, when you go to TripAdvisor and type in things to do in San Diego, sitting through the NEIC Accounting Practices and Procedures meeting is not high on that list, but we had 2,000 people showing up to sort of be a part of a process to develop regulation. And that's, I think, a strength of our system. It is in stark contrast to what we see when we go abroad. We had sessions on valuation, on group capital, on group holding company, on reinsurance, and how all those things are going to work. And you've got every shape and size of insurance company. You've got every constituency. You've got insurance agents, adjusters, risk modelers, consumer groups, the American Cancer Society, AARP. You've got every kind of vested interest in the insurance market is sort of there, commenting, asking questions, standing up at a microphone and agreeing or disagreeing with what we're doing. And I think that when you come from that culture that's been built over 145 years, and you go and you get on a plane and you travel to Basel, Switzerland, to work on consequential regulatory policy entirely behind closed doors, with really almost no justification for it. I mean, we're not talking about nuclear launch codes here. We're building insurance regulation. The idea that that needs to be done behind closed doors is just frankly absurd to us. We, the NEIC, state regulators have pushed very hard at the IAS to open up more of what they do. And we have a culture in the U.S., I mean, if you look at how states are organized with all of their open record laws and their sunshine laws, the default is you get to see everything, and only in certain exceptions can we make things confidential. You go across the pond, it's the absolute inverse. Everything is confidential, and only in rare exceptions will we let you in and give you a glimmer of what's going to happen. And we've all seen transparency that looks like a 30-day comment period, but then you have no insight into any of the decision-making that comes out with the final product. That's not how U.S. insurance regulation works, but that is what's happening abroad. So we've been pushing very hard, and we know that the industry has been pushing very hard as well, and Congress has gotten involved, and I think it was honestly congressional interest in that issue, as arcane as it may seem to some of you, is really what sort of put some pressure on the IAS to open up their doors a little bit more. Now, they've made some initial efforts, but they have a long way to go before they really get to true transparency, and that's one of the things we've been pushing for. We think congressional interest in that is critical to sustain and maintain going forward. Terry touched on the Financial Stability Board, which has really kind of taken on a life of its own. There's an org chart for the FSB I should make available to you. It's when it started as the Financial Stability Forum, it had maybe 4 or 5 boxes on the org chart. Now there's about 70 boxes. They have a as Terry said, well-intended, but a significant workload that then gets pushed down to the regulatory standard setters. And people will tell you, well, none of this stuff is self-executing. None of it has the force of law. You have to take it on board and adopt it in your system, which is all very true. But there is tremendous political pressure on regulators. And frankly, even if the U.S. does its job and says this just doesn't frankly work for us, other jurisdictions may take on those standards. And so when your U.S. companies are going abroad and competing, they're going to run into these standards. And so you have a vested interest in trying to shape them. You want them to be high, good quality standards, but you want there to be enough flexibility so that jurisdictions can sort of fold those into their systems. And that's one of the tensions we've had at the IAS, is sort of getting that done. There is, as Terry said, no insurance regulator really involved at the FSB. We have a couple of insurance regulators, state insurance regulators, I should say, involved in 1 or 2 of the work streams, sort of on almost an observer basis. But there's a lot going on at the FSB, and we have asked repeatedly to have more inclusion of state insurance commissioners in any discussion that relates to insurance. We're not trying to displace anybody, but we think that the U.S. is at a competitive disadvantage if you don't have one of your key financial regulators in this room. And I think that needs to change. I think Congress has taken an interest in that, and it's something that we believe very strongly in. Last but not least, I think it's important to remember that because of the structure of our system in the United States and because of the Dodd-Frank Act, there are multiple actors for the U.S. in participating internationally. And that's not necessarily a bad thing, because I think what we've seen is if you try to have one regulator wear all the hats, they have a certain bias, and certain issues get left on the side of the table. And it tends to be the insurance issues that get left on the side of the table and not fully considered. And so we think it's really important that insurance regulators have their own sort of independent voice. After all, we are a founding member of the IAS. We remain its largest dues payer. And as Tom said, we regulate 100% of the U.S. insurance market, and we share some of that responsibility with certain firms with the Federal Reserve. So there should be a fair amount of deference, I think, from our federal colleagues to the state regulators in those discussions. And there have been some good examples of late where we've seen more of that. We work together very closely with our federal colleagues, for example, to insert some flexibility in the valuation standard that Terri talked about. But it's been few and far between, I think, and there's far more that can be done. And I think we've had a pretty constructive working relationship with the Fed in particular, but there have been some growing pains, frankly, with the Treasury Office as it sort of tries to figure out its role, because it is not a regulator, it's a finance ministry, but yet they've been given this responsibility in the Dodd-Frank Act. So I just want to impress upon you the importance of keeping those distinct roles and preserving them, not trying to sort of sugarcoat them or diminish the role of the state insurance regulators in this process, because I think ultimately we are the only ones there who have to juggle affordability and availability of insurance in all of your states. So with that, I'll just turn it back to Rob.
Thank you, Ethan. Mark, the bases are loaded. Bring it home.
Well, first, it's a pleasure to be back in the hearing room. I have lots of good memories from this room, a few bad ones too, but I'm not going to talk about those today. I will say one of the nice things about leaving the Senate is for some reason it's easier to get Robert to agree with things with me now than it was when I was up here. Although I have learned if I simply write HR in front of it, Robert's much more amenable to it. So I think some of those biases still remain. Let me also say what a pleasure it is and an honor to be with my rest of my panelists. And if you're interested in some of these issues, Terri and I wrote a paper a year ago that is on the Cato website. All the really smart, insightful stuff in the paper is from Terri, but it's a really great resource, and I certainly encourage you to go there or ask any one of us for it. Let me also start with, really, if you're familiar at all with things that I write, you might not be surprised to hear that my primary interest here is financial stability, or as I often put it, I really, really, really hate bailouts and don't want to see them anymore. I am concerned about economic growth. I am an economist after all, and I am concerned about consumer benefit, but my ranking is no bailouts, and let's try to make sure we don't go that direction again. Since I am back in this room, I hope you indulge a little nostalgia on my part if I can start with a bit of a story. And granted, since I've got a little bit older, my dates are slipping, but I remember being in this room in 2003, 2004, when we were having a hearing. The room was set up slightly differently, but I do remember Susan B., then a governor of the Federal Reserve, was at the table, and I remember at the dais then Chairman Shelby. Again, Chairman Shelby, then Ranking Member Sarbanes, both expressing very, very strong skepticism about Basel II at that time, and really just hammering. I felt a little sorry for Susan B. almost at that point, how tough they were on it, but ultimately it was incredibly important. And I think the fact that a bipartisan consensus from the chairman and ranking member was made very loud and clear to the Fed at the time that the direction they were going with Basel II would undermine financial stability and result in higher leverage in the banking industry was something the Fed took to heart. And quite frankly, and again, I will say, my friends in the House were raising similar issues. I wasn't over there as often, although I did occasionally make my way over. And to me, I really think that this expression of concern from Congress is what delayed the implementation of Basel II in the U.S., and I say thank God for that. Because if you look at the response of European banks in the crisis, they did so much worse. And one of the reasons was the adoption of Basel II in Europe. And as highly leveraged as U.S. banks were, they were all well capitalized compared to the typical European bank going into the crisis. Unfortunately, the SEC had pushed U.S. investment banks to live under Basel II at that time, and I think we saw how that turned out with Bear and Lehman. So again, it's important to remember that as many things as went wrong before the crisis, a few things went right, and one of those things that went right was this body and the lower body expressed some concerns to the Federal Reserve, and the Federal Reserve delayed implementation of Basel II, and again, we're all much better off because of that. And so I worry that one of the themes that's come out of the financial crisis, and particularly this approach to insurance regulation, is that we should essentially model it closer on bank regulation. And so if there's one point I want you to walk away with, bank regulation did not work well before the crisis. So the notion that somehow MetLife or AIG, if AIG had only looked more like Citibank before the crisis, we would be okay, all due respect to my friends at Citi, I think is absurd. Now, Terry mentioned this, and I think this is something to certainly be recognized and applauded. What the Federal Reserve has come out is a recognition of that, that insurance companies are not banks. Ethan touched upon this as well. Quite frankly, I don't think we would have seen that from the Federal Reserve had it not been for congressional and public pressure along these lines. I think if the Fed had simply started on the way they wanted, we would see something like Solvency II, which is a lot like Basel. It's important to keep in mind that despite what I think has been a much more reasonable approach than some of us had feared, the Fed, along with the Treasury, which really does dominate Team America at these negotiations, is still driven by a worldview that all of financial services looks kind of like banking regulation. And again, I would emphasize that might not matter if banking regulation worked well, but it doesn't. And it's also important to say, even if banking regulation worked really well, it still may not be a good fit for insurance, which I don't believe it is. Insurance is not dependent on short-term deposit funding. When you hear these arguments that depositors and insurance policyholders behave the same, and literally, if you go and look at some of the justifications, such for instance, my favorite is if you look at the justification for the designation of MetLife, where FSOC argues that the fact that insurance regulators might suspend policyholder redemptions, which would cause runs, it's absurd. That's not how insurance companies work. So again, this very 1930s bank run view of the world is again not how insurance companies work. And to see some recognition from the Fed and the Treasury on that would be nice. Let me also emphasize, to me, a robust financial system, reminding you that my primary concern is financial stability, is a system characterized by diversity. And how does that mean? What does it mean in an operational sense? Well, one way it means is that when banks need to sell to raise money, that insurers might well be willing to buy assets at that time. You need balance sheets to look differently. You need funding models to look differently, and that way you will have a more robust financial system. One of the real problems that has come out of the Basel framework is it has pressed and forced more homogeneity across bank balance sheets, which to me has undermined stability. And so I worry that if we were to continue to go this direction and end up making insurance companies look more like banks, we will make risks far more correlated, which again will lead to more financial crises rather than less. So again, I think having a different approach to insurance is incredibly important. It's also, Terry touched upon this, but let me emphasize as well, a lot of the direction under Solvency II in Europe simply has different objectives. So, for instance, one of the objectives is that insurance companies and banks are far more likely to be under the same holding company in the EU. But even more importantly, and one can debate the greater perspective of whether we should have a state-based system of insurance regulation in the U.S., but we do have it. That is not the objective in Europe. The objective in Europe is a common market. The objective of Europe is a single EU-wide system of regulation, where the countries are essentially administrative units of the EU. That is not our objective in the U.S. If we want to go that direction, that should be debated. It should be decided here. It should not be decided by the regulators. So again, since neither one of these objectives are important in the U.S., I would again argue that Solvency II is not the right approach here. But let me wrap up with emphasizing again, congressional oversight in the banking area and in the insurance area has been critical. I should mention that maybe I will mention one or two of my earlier bad memories from this room, in which is I often was tasked as a committee staffer on working on some of the areas where the federal government had largely taken over the insurance sector. And that's, for instance, flood insurance, you might have heard of that, mortgage insurance. These are some things I've worked on. I don't think I need to tell anybody that these are two areas where there have been taxpayer bailouts, where they have been very poorly run. I can't think of anything worse run in the insurance industry than the National Flood Insurance Program. And again, that's no state involvement in that at all for the most part. It's completely federalized. So again, to summarize, bank regulation doesn't work well. Federal government, horrible track record in the area of when it's actually run its own insurance programs. And lastly, again, the importance of Congress weighing in, because the regulators will push forward with their vision of the world if they don't hear from the rest of us. So hopefully, given a little bit for us to talk about.
Thank you very much, Mark. Hopefully, they will weigh in. Where there's a will, there's a way, so we can get to that point. Happy to take audience questions at any time. Feel free to step up to the microphone if you have a question. I'll start it off, but anyone who wants to ask a question, just please come up and I'll recognize you next. And Ethan, I'm going to start with you. Congress has expressed increasing concern about the lack of accountability and transparency in the process, and you talked about that in your statement. Are there upcoming negotiations or decision points over the next year that are important and then could impact the marketplace? I mean, is this something we can just put off and worry about next year, or is this something that we need to be addressing right away?
Yeah, that's an easy one. I think they call that a softball. There's lots going on right now that it's just sort of critical for the regulators to weigh in and to have more transparency on. And I'll just mention a few. I think at the IAIS level, as everyone on this panel has talked about, they're developing a capital regime that looks a lot like Solvency II. Now, we have worked really hard with our federal colleagues to get some flexibility into that standard to not put U.S. insurance companies at a disadvantage, but nevertheless, there are major consultations that are out right now pending where the IAS is seeking feedback on the elements of that. That is happening largely behind closed doors. There is field testing of insurance companies, sort of running through that standard to see how they will perform. That's all behind closed doors. Most of the meetings, frankly, are behind closed doors. We're working on macroeconomic policy, macroeconomic surveillance, resolution authority. So what happens when an insurance company fails? That's the sort of bookend to solvency regulation on the front end. These are foundational elements of insurance regulation, all being worked on this year, for the most part, all happening behind closed doors. There are occasionally observer sessions where some of these issues get highlighted. The industry gets up and says a few words, and then the group goes right back behind the closed doors to continue tinkering, and you really have no sense of feedback. There's very little involvement in sort of the early stages, where, as you know, for those of you that have ever worked on legislation, it all starts with a member and then some committee work or a subcommittee, and really that's where a lot of this stuff gets cooked. By the time it gets to the floor of the Senate or the floor of the House, all that's left is the champagne or the tears, depending upon how you feel about it. So just waiting for that and saying, oh, there's transparency now, that doesn't cut it. I mean, anyone who's been in this town long enough should know that doesn't cut it. One other that we haven't really touched on, but I wanted to make a point of referencing is right now, Treasury and the USTR are starting negotiations or have been in negotiations on a covered agreement. That is an agreement between the U.S. and the EU to address certain prudential issues that has the potential, anyway, to preempt state laws. Now, we've been very wary of this. We've been very outspoken in our concerns. But the biggest problem I see right now is that none of you know anything about it. None of you have any ability to know anything about it. It's all happening behind closed doors. And there's really no law or requirement that any of this plays out behind closed doors. In fact, trade agreements, which are far more sweeping, have a vote in Congress, unlike a covered agreement. There are stakeholder sessions where they get feedback from various industry sectors. These are monumental trade agreements. They have more transparency than this thing. And you're going to basically potentially preempt all 50 states with what you embed in this agreement. And we have a handful of commissioners who sit in the room as observers. They have no ability to talk with their fellow regulators, no ability to talk with the industry, no ability for consumer groups to weigh in on whatsoever. And there's really no reason for it. So that's playing out right now. And I think that's an opportunity for transparency that's sorely lacking.
Robert, can I just speak to this transparency issue for a minute? Because one of the things, we used to talk about this a lot, and it was clear at the IIS and at most of the other international meetings, that there is a view that having open meetings gives the industry too much influence. And that is just not what it does. This is the challenge, is getting that point across, that it can work, you can have open meetings, and that it actually results in a better process and allows all views to be heard. Ethan will remember when the Affordable Care Act was passed, and we were asked at the NAIC.
Which one was that?
Yeah. And we were asked at the NAIC to make a number of recommendations to HHS on implementation of the Affordable Care Act. And we undertook that work. the same way we had always undertaken our work, which was in a very open and transparent way. Well, we had different people involved, different groups involved. We had more consumer groups from D.C. who were now participating in our conference calls. And the way we do it is, you know, we put a conference call out there and anybody can dial in and listen to it. And they were, the feedback we got from these groups was so gratifying, because they said, this is just tremendous. We can hear the regulators debate. We know what they're thinking. We know why they end up where they are. We get the same voice as the companies do. Now, that protects against excessive influence. What you get with closed meetings is excessive influence from those few companies who are connected to the regulators. And that's why companies spend so much money hiring people who are connected to the regulators so they can influence the process when the doors are closed. Open up the doors and let everybody see what's happening.
If I could just add a
Just,
couple.
Tom, I want to ask you a question on that, and then please add. Isn't it, because you were there at the time this all occurred, wasn't it consumer groups also that were kicked out of the working group meetings?
Yeah, that's exactly what I was going to get at, was with the IAIS, some of the expression has, by many international regulators, has been, we don't feel comfortable if we're going to make debates on policy in front of, it's just a complete opposite mindset of what we have here, and as Terry just described it. And, you know, the problem with the IIS is we spent 2 years, because we do have paid consumer groups that the NAIC funds their travel and helps them to focus in different states on key issues to consumers. So we thought, you know what, these are important issues internationally, so why don't we have something similar at the IIS? And we managed to finally get it approved less than a year before they pulled the plug on the whole thing. So, you know, we had two of the folks are from Connecticut, Sonia Larkin-Thorne and Professor Peter Kotchenberger, yes. Peter Kotchenberger is one of my close friends, believe it or not. So I'm all there today, you know, yes. But, you know, Sonia came to Taiwan and talked about this issue at the IAS's Taiwan meetings. She was incredibly elegant and eloquent in her remarks. Peter has made similar comments in the past. And then 1 year later, they pulled the plug not only on the industry, but on the consumer groups as well. So you've lost all of those voices. And that's also very troubling. The other thing that's troubling is when there was the vote on this in Amsterdam in 2014, we are capped, I think it's 15 votes, right? We have 56 memberships because every state is a member and the NAIC, but we've capped our votes to 15 so we don't potentially have the opportunity to dominate the industry group or the IAS itself. And all of us, all 15 votes, voted against making this change. But the Federal Insurance Office voted for it. And I listened to the testimony in this room several months ago, and the argument was it was more transparent. And so I voted for it because it was more transparent. Well, that's just nonsense. It wasn't more transparent. It closed the doors, as Ethan and Terry have just said, and there was no justification other than perhaps just saying, I'm going to vote differently than the state regulators do. And that was extremely disappointing.
Terry, now that we do have multiple voices involved representing the U.S., do the federal agencies involved, do they have the same consumer-focused mission that the state regulators do, or do we have different competing missions now?
Well, I think Ethan already said this, that it's the state, Ethan or Tom, somebody, that the state regulators are there to protect consumers and to balance the solvency and the availability of products that are, so the state insurance regulators look at the market. They want a market that is delivering products to consumers that consumers want and need at fair prices. They're paying the claims when they need to. They have the financial wherewithal to pay the claims, and they pay them properly. So they're looking at the whole picture. The Federal Reserve, I think, has certainly a financial stability role and a role in supervising the thrift holding companies, but it's really more focused on the depository institution, protecting the depository institution at both the depository institution itself and the holding company, which may impact the depository institution. And then, of course, supervising those institutions that are designated by the Financial Stability Oversight Council. But it's much more, I see it as much more of a prudential and financial stability role. And then FIO, of course, has a role of monitoring, essentially monitoring, and representing the U.S. At the international, in the international arena, and then some kind of narrow role in international agreements. So, yeah, the state regulators have a very different role, and they're the ones, when I was a commissioner, and Tom can attest to this, we had a steady stream of consumers calling us or coming in the door with issues that needed to be dealt with. The Federal Reserve doesn't have that. The FIO doesn't have that. It's the state regulators who are on the front line dealing with the problems that the consumers have.
So Mark, let me ask you, as Terri says, you have these different entities with the different roles. Has Congress given them guidance as to when there's a conflict? Is it the consumer protection role? Is it a solvency role? If FIO is supposed to represent the U.S., what does that mean? Or is this something where Congress should be providing sort of very high-level clarification?
Well, certainly, I think you can, to judge from the activities of the regulators, that apparently they aren't clear on what their messages are, or they've decided otherwise. Let me also say, as an aside, judging from things like Brexit, I have to say I'm really surprised at what might be the suggestion that there's a lack of democracy and accountability in the EU. So who would have guessed that they aren't necessarily listening to people there? And I think it's unfortunate that if we're going to try to adopt that kind of model of governance. But I do think that this is an area where, to me, and Ethan mentioned this, I mean, I think from Dodd-Frank, and as people know, I'm a Dodd-Frank critic, but I think the role of the Federal Insurance Office is actually pretty clear in Dodd-Frank. I think what we're seeing is an attempt to go beyond that. And unfortunately, if Congress needs to come in and clarify what that role needs to be, then perhaps that's the case. I think also with the role between the Federal Reserve and FSOC and the federal regulators should be clearer. I think it should have been fairly clear from the construction of FSOC that the fact that you have insurance regulation representation, the purpose of that should be obvious to listen. And the fact that the insurance representation has been often ignored, and ignored when it's been most loudly on FSOC, I think is problematic. So perhaps, again, that might not be harmful for Congress to clarify what shouldn't be ambiguous, but apparently is ambiguous to some federal regulators.
Let me pause for just a moment before I proceed. Are there audience questions? Ronnie?
Thank you, Robert. Good afternoon. I'm Ronnie Lancaster. I work for an insurance company called Assurant. And first, our sincere thanks to PCI for hosting a terrific program. And thanks to each of you for participating. We are a domestic insurer with an interest in increasing our international footprint. And so this discussion is very timely and helpful for us. As a domestic insurer, despite the very good work and talents of state insurance commissioners, we do find it challenging from a regulatory and compliance perspective to balance the requirements of 51 jurisdictions. And despite the legislative intent of McCarran-Ferguson and Dodd-Frank, we also are finding it increasingly challenging to respond to the increasing inquiries and demands of the executive branch of the federal government. As we now entertain the prospect of entertaining a third set of a third regulatory regime from our international friends, the solution for us, we believe, lies in increased coordination with our federal and state regulatory friends. So my question to the panel is, may I ask you to describe and speak to the need for increased collaboration among federal and state regulators? Thank you.
Well, I thank you for the question. You know, we refer to the 3 C's: collaboration, cooperation, and coordination. And I think that is, again, if we go back to the comments that we made early on, the prescriptive one-size-fits-all approach, or trying to cram down somebody else's regional system against all the countries of the world, isn't going to work, and it doesn't make sense. But what you're getting at, I think, is really the critical factor, which is, and we talk about this in supervisory colleges of large internationally active insurance groups and reinsurance groups, is that if you understand what's happening in these companies, where the risks are, how good management is, how good their governance is, how they approach the markets, how they deal with consumers on a market conduct basis. And you have, let's say you have a company with 15, it's in 15 countries, and you have the chief regulators of those companies participating at the supervisory college. That's where the coordination, not just in the meeting, but quarterly, and if something of a crisis orientation comes up, everybody's alerted, the lead regulator is on top of it, the company's management team is being brought involved, and you have a holistic view of the company as opposed to, let's check the box and see if they've got this much capital, as if the capital is the only thing that matters, or if we're going to use this kind of valuation system versus that kind of valuation system. So I think the issue is if we could get out of a lot of where regulatory quote-unquote convergence discussions have been coming out, which is let's all go to one thing, and focus instead, and Terri says this all the time, on an outcomes basis. Are systems appropriate? Do they protect consumers? Do they ensure solvency, and so on? So I think that's, that's exactly where we need to get to. Unfortunately, a lot of the effort right now amongst various regulators and policymakers is contrary to that. One of the examples is with AIG. I've heard some folks say, well, AIG was an insurance company, therefore it's a failure of regulation. Well, it was a failure of regulation. It was the failure of the federal government's regulation when the Office of Thrift Supervision, who was deemed as the group-wide supervisor, had never called a supervisory college, had no sophistication whatsoever in understanding the issues and risks and size of that company. And you'll have some folks say, well, we need to put more capital. Capital is the silver bullet. But capital really isn't the silver bullet, because in AIG's case, if you had, $20 billion more capital, it wouldn't have made a difference. But what might have made a difference is if all of the regulators of that company were involved in a supervisory college, and there was collaboration and cooperation and communication, so that somebody somewhere, maybe in Texas or in Pennsylvania, said to the Office of Thrift Supervision or the UK, you've got this huge growth of business, and it's highly complex business at the financial products groups in London. Who's looking into that? Who's managing that? What kind of risk processes do they have in place to protect against this thing blowing up? That might very well have been able to prevent the crisis at AIG, whereas more capital or a check-the-box mentality wouldn't have. So thank you for the question.
There is no question that as you add more layers of supervision, you get more and more need for coordination. And the supervisory colleges, as Tom just said, one of the things that we had hoped is that they could evolve into something where there was a collective, collaborative way of dealing with issues. We were hearing early on, when there was an earthquake in Texas, a company would get requests from 20 different regulators around the world. Please tell us what your earthquake loss is. And all different formats and all different time frames. And these are the kinds of problems the NAIC is very familiar with. So what we were trying to get to was, let's see if we can't use the supervisory colleges as a basis for those sorts of things so that it doesn't add unnecessary costs to companies. So it's very clear there's work to be done in that area. One of the frustrations for me is that all of the hours that are being spent on the international capital standard, the insurance capital standard, mean it's not being spent on this, which would be very productive and immediately beneficial to the companies. So there are sort of two worldviews that are going on. There's one worldview that says, if we can get the rules just right, then we're going to let one regulator handle it all and we'll all trust that regulator. But you'll never get the rules just right. You never will. It can't happen. You look at what happened with the Basel Committee, and it was a constant, they just spend constantly trying to fix the problems that the capital standard is creating. So you'll never get there. Or the other one, which is, look, let's accept the complexity and figure out a way to make it work in a collaborative way. And we're not spending any time over here because it's all going here.
Let me ask, we have one more question from the audience, and then I'll wrap it up with one final question.
Yeah, Robert, thank you. My name is Stan Golansky. I'm the President and Chief Executive Officer of the Navigators Group, Inc. We're a U.S. publicly traded insurance holding company, and we employ about 700 people worldwide, about 550 of them in the U.S., and we're a U.S. taxpayer. During the 36 years I've been in the business, I've watched the U.S. reinsurance industry vaporize. And it is a shadow of what it would have been 36 years ago. That's history. But when I look at the discussions, and here, as I think I've heard today, that there are 36 meetings between now and the end of the year around regulation of financial standards that could impact the U.S. insurance industry, it's frightening. And so I ask, as a practitioner, as a person within our industry, how can our industry get a seat at the table, and how can we raise awareness around this subject that this is not about just capital. It's about jobs, and it's about an industry in the U.S. that is well-regulated and serves consumers well. What do we do? How can those of us in the industry help this?
And that actually segues into the question, answer Stan's question and mine. If you can make one suggestion to members of Congress and congressional staff on their engagement, particularly given the concerns that Stan just raised, what would your suggestion be? Is timeliness important, and what should be the priority? And why don't we just...
Okay.
Tom, I want to...
Well, I think timeliness is very important. I think you have that handout that shows all of the different activities that are going on over the next several months. So, you know, it's easy, as I said earlier, these are somewhat esoteric if you're not involved in this industry and living and breathing it, but they are really important issues, and I think you've just highlighted why they're so important, Stan. So, I mean, I think, and Mark said it earlier on, I think the engagement of Congress and congressional staffers is incredibly important to understand why these issues are so important, and why some of the changes that we're talking about in terms of transparency, of protecting our system from having an international system forced upon it without any benefit to consumers and the industry, but in fact may be detrimental. So that's what I would encourage.
Yeah, I would say strong oversight, and I would say a healthy appreciation for the fact that there are biases operating in the international arena right now, very serious biases. And I wanted to have an opportunity to get something in here, so I'm going to do it right here. And that is, if you read the International Monetary Fund's April Global Financial Stability Report, it says two remarkable things in it. One, it says, and I'm quoting, U.S. life insurers acted countercyclically in 2008. The quote, "The overall contrarian investments by the insurance sector contributed to the stability of the U.S. corporate bond market in that period." So it's about jobs, and it's about consumers, and it's also about financial stability. Okay. Then they go on to say, oh, by the way, the correct method of valuation for insurance companies is market consistent. And then they go on to say, now, of course, we know that that will create pro-cyclicality, so we're going to have to introduce counter-cyclical capital measures. Now, this is a bias. This is a bias. And it is a bias that has very serious consequences for financial stability in this marketplace. And that's the debate around market-consistent valuation. It's an important one, and I hope that you are thinking about these things in a healthy, skeptical way.
If I could just add one thing on that. I did a speech at the United Nations last June, and it was on this very issue of why I think the topic I was asked to speak about was how does insurance regulation impact social stability and economic development. And I thought, I have no idea. But I realized that you can do things that can really, in a negative way, impact both of those. And the issue of, if you think about Solvency II and market-consistent valuation, and yet at the same time they allowed no haircuts on investments in sovereign wealth, and yet, of course, we saw what happened during the second financial crisis when you had several countries nearly bankrupt and a lot of issues. They were anything but safe debt. The other thing is, if an insurance company, not only does it create pro-cyclicality, but insurance companies are the biggest investors, or among the biggest investors in long-term infrastructure. And so if you're trying to do economic development, whether it's creating long-term infrastructure in developing nations or rebuilding crumbling infrastructure in countries like ours, if you make it a detrimental policy for insurance companies to be able to make those kinds of investments, then you're basically going against the public policy that you're trying to create. And the same thing when you look at the ability to invest long-term to match long-term liabilities. If you have retirement-type products, particularly when you have local and federal budgets being strained after the financial crisis, where if you have private sector solutions where people can buy affordable products for their retirement, but all of a sudden you say insurance companies are going to be penalized for investing in long-term assets because of this market-consistent valuation, you're making it less attractive for them to offer the very products from a societal basis that you want them to make. And I think that's the double whammy that's unrelated to just regulation, but to social policy as well.
Mark, short final comment on what Congress should do?
Well, since my colleagues are not able to make short final comments, I think I might make a long final comment too at the indulgence. Partly because, it's been mentioned, myself, Tom, and others, and I think it's a core sort of myth about the whole conversation about AIG, and I want to take just a couple seconds to mention something that I think is crucial, because I do think underlying much of the conversation is this notion of, well, AIG screwed up, therefore that's a failure not only of the OTS, which we merged with the OCC, but also the state regulators, when the facts with AIG are simply the largest banks, starting with JP Morgan, went to the New York Fed and said, can we use credit default swaps from AIG to lower our capital? And the New York Fed said, yes, that sounds brilliant. And of course, all the New York Fed had to do was say no, and that never would have happened. And you can go back to the financial disclosures from AIG at the time. They were very, very clear that the overwhelming majority of their credit default swap business was for bank capital arbitrage. This was not a mystery. Anybody do the research. And the reason I raise this is that, again, this assumption and assertion that somehow we will have a safer financial system if we put Ethan out of work and we give these responsibilities to the Fed. I think that would be a gross mistake. But I will end with this segment of the comment was saying, I do applaud the Fed bringing on Tom Sullivan, former Connecticut insurance regulator. I think it has been helpful to get an insurance perspective, so they've certainly done some things right. But to echo, Terry used the word skepticism. If I would say anything to members of Congress and their staff, you have to be skeptical about what the Fed and what FIO and Treasury. I mean, granted, my 7 years up here taught me I should be skeptical about everything the executive branch under any administration says. But this isn't particularly the case here. And Tom also mentioned, this choice between infrastructure and between sovereign debt. It's important to keep in mind that one of the problems with FIO is that FIO is an arm of Treasury. And the primary responsibility of Treasury is first and last funding the debt. It's not by happenstance that when you put a group of finance ministers in a room in Basel that they decided that things like Greek debt were risk-free. This was not an unintended consequence. It was an intended consequence, and it turned out horribly. So ultimately, I do think one objective is we need to get the finance ministers out of the room, quite frankly, because their solution to everything is going to be if we just stuff financial institutions with more sovereign debt, everything will be great. That is their solution to everything. You see it, liquidity coverage ratio. And again, that will mean less infrastructure investment. That will mean less private sector investment. That will mean less return for policyholders. So, and again, it also, in my opinion, means less financial stability.
30 minutes left, right, so I can just filibuster. No, other than the plug for my continued employment, which I totally agree with, I think it's critical to financial stability. Now, let me tell you a story. This was before my time, admittedly, but during the late 80s, insurance companies were facing sort of a rash of insolvencies. And the states were really under the microscope for really having ineffective solvency regulation. They were, it was different from every state. It was discombobulated, and it just wasn't very effective. And, there was some self-awareness, certainly, but it was actually congressional oversight and congressional interest that really highlighted this and made it real valid for not just insurance regulators who have to sit there and suffer the slings and arrows, but for governors and state legislatures as well. And out of that came the current risk-based capital system that, by and large, has carried us through the worst financial depression since the Great Depression. So congressional inquiry and interest and pressure is a useful tool, and it really can push the regulators to focus on what matters most. So I guess I would say, if you're looking for what Congress can do, don't go to sleep just because you passed Dodd-Frank. There is lots happening as the regulators implement elements of that. And in the insurance space, people like to say, well, insurance was sort of largely left out of Dodd-Frank. Well, we live in an interconnected financial services world, and if you do something to how you look at a mortgage, chances are you're going to impact an insurance product. I mean, there's a lot of interconnections out there. So insurance is impacted by what's happening, and I think Congress has an obligation to continue its oversight. And to Stan's question, what should we do? We have all these international layers of regulation coming at us. I feel pretty confident saying that at least from the point of view of the state insurance regulators, we're not going to adopt any standard, taking anything on board that isn't in the best interest of U.S. consumers or companies. And if we even think we're going to do that, it's going to go through that process where you have to get on a plane and go to San Diego, and you can yell at us for 4 hours, and then it's going to go to the state legislature where there's an open and transparent process there before it ever becomes a reality in this country. It may be painful, but that's how it works, and that's how you get a better work product. So I think just continuing to sort of defer to that system is obviously the way to go.
Well, I want to thank our panelists. This has been a great dialogue. I encourage anybody in the audience, these are some of the best minds in the industry. If you have thoughts, questions, areas you'd like to follow up on, please follow up with them. I'm sorry, Nicole? What's that? Any more questions from the audience? Any final questions from the audience? I do want to say, this is one area where congressional involvement has been enormously helpful over the last couple of years. There's some great legislative efforts in play. We strongly encourage those efforts. We hope there can be a good bipartisan meeting of the minds. And again, any questions, please, we're happy to help and appreciate your involvement and leadership. Thank you, everybody.